Hey guys, hope you are all having a fantastic weekend so far. At the end of last week, things seem to have taken a dramatic turn for the worst. News outlets began warning that war is imminent, and that Russia is set to begin an invasion of Ukraine, which could be met with a full-out war. Markets retracted and began losing some of the gains they had made, including GameStop and AMC. The biggest hurdle for the stock market, however, was the horrid inflation report, coming in at 7.5%. This bled out major indexes, and though meme stocks among others attempted to continue upward trend, the negative news defeated the upward continuation that they were poised to enjoy. Let me preface the following topics we are bound to discuss by stating, nobody knows what is going to happen this week. The markets all rest uneasy as a conflict in Europe would easily defeat whatever strength we have left and send us to the nether realm. On top of this issue, which hovers on the top of every investor's head, lies yet another upcoming catalyst. The rate hikes are meant to begin in March, and as we near them, we could see more price volatility. Investors don't really know what to expect, and because of it, you will see markets behaving a little erratic. We must approach any market in a humble state, for uncertainty has never been so accentuated over all matters in the world. I want to encourage you folk to hop on over to my Discord. There, we will be discussing market conditions and enjoying the company of each other. You are not alone in any of this, and it is your sole choice to brace through the storm alone or with your diamond hand brethren. Link will be down below in the comment section and in the video description, so quit wasting time and join us, for we are all embracing your arrival with open arms. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. This past week was way more influential and important than most people give it credit for. Yeah, watching Chad GameStop and AMC rip and move strong was a sight to behold for sure. I absolutely loved watching these two stocks rip and tear through everything, but that does not mean we should now ignore the fundamentals. Markets just had a pullback greater than 5%, a figure we haven't seen since the onset of the pandemic. As I have said, this dip marked major indexes as entering the correction territory the media told us not to worry about. GME and AMC might have been bullish, but the rest of the market was bear, and because this isn't a market crash, at least not yet, this means that there is a divergence, a gap, between what investors are looking to get in anticipation for what could come. In other words, investors are looking for a direction. We are all helplessly looking at each other for meaning, for sensical and logical moves that will give us a solid set of expectations and grounded rationale by which we can make better decisions. One thing stands clear above it all: it is impossible to determine how long this could last. One factor that has always had a big effect on markets are midterm elections, which historically end up causing dips and stress on the markets. And back to the Fed, many think that issuing rate hikes will solve economic problems. Many are under the impression that the Fed will be able to snap their fingers like Thanos and have reality be what they want it to be, but this is a very misplaced sentiment. The Fed cannot solve the high cost of energy, which, by the way, was the main reason why inflation jumped to 7.5%. Rate hikes won't fix supply chain problems nor labor shortages. With all this in mind, what do we do? Of course, this isn't financial advice, but I will be dipping my feet all the way down and buying every dip. What will come out as a consequence of all this market turmoil is a huge bullish run that will make up for it all. Looking at historical charts, every time the markets and the economy go through a tumultuous phase, the following run always exceeds what the average gains would have been and more. The markets will bounce back strong, and with it, everyone buying this dip will truly begin to see serious rewards for the patience. GameStop and AMC will continue to be shorted, but this dip has the potential to make things harder for shorts long term. You see, ape mentality hasn't changed. This dip has been met with nothing but buy and hold to the moon, which means investors have been scrapping up more of the float than we have ever had been since last year. With millions of investors buying every week, with no intention to sell, it will become harder and much riskier for shorters to delay the inevitable. Having said that, I do not want you thinking that MOASS will be imminent upon market volatility resolve. Remember, shorters are using options to stab and bleed meme stocks out as much as possible. They want to take these prices down even further than they already are. It's what they have successfully been doing for months now since that last run on June of last year. This is pretty much everything I wanted to talk about in regard to what you needed to know moving forth this week. War could happen, and because of it, markets are poised to be very volatile this week. AMC and GME could experience a setback, which we will then examine where we build most support on. They both surpassed 30% in gains this past week at the highest point before they went down a bit, but are still sitting comfortably around 23% gains on average. I want us to consolidate at these levels for more upward consolidation, but if we fall down back to where we were in the beginning of the week, do not feel lost or disappointed. Right now, everything is a mess and it should continue to be for a while. Every stock is honestly undervalued, and you really have to be bad in the market for you to lose money long term. Stay strong, stay the course, and put those diamond hands up. I will skip over charting today because honestly, it doesn't matter for what could happen this week. If the reports that Russia will invade Ukraine this week are true, forget any technical analysis, just get a parachute so that you can land safely from the nosedive that everything will take. Instead, I want to talk a bit about central banks and supply and demand. This portion of the video will be wrinkly, so pay attention. Supply and demand is a very simple concept. Prices go up and people tend to buy less of the product. Price goes down and people tend to buy more of the product. Central banks have forgotten this very crucial rule to economics, as they have normalized inflation as being good and deem it optimal to target its rates at 2%. Deflationary forces, led by the internet and low-cost production in China, have offset inflation pressures from money printing. It didn't matter how bankers would attempt to create inflation, online retailers would always fight and drive prices lower. They got away with this for a decade, but the pandemic changed things. It gave central banks the excuse to wave inflationary fears away, calling them transitory, and telling government officials and the public that it would go away on its own soon enough. The United States became increasingly scared of China, and began placing tariffs as much as possible to force companies to start looking elsewhere for alternative sources. China has been slowly moving away from its unprofitable enterprises and leading the supply of goods to decline. China's urbanization, which we have talked about, now played out, and the supply of low-cost labor has slowed. As the size of the workforce declines, also driven by China's large aging population, the wages have to rise again if they intend on keeping workers from finding new jobs. What I am doing by putting all this in the table is showing you the demographic trends that make up the basic forces for supply and demand. Demographics trends were once a significant argument in favor of inflation, but now the contrary might be the case for China. Earlier I mentioned that the internet has changed things. Some time ago, brick and mortar ruled while online shopping was just a small side revenue income. Now, brick and mortar stores are out the door, leaving malls empty. Online retailers have found that for convenience, consumers are willing to pay more, which means they have leeway to charge extra. This will cause prices to go higher, but it will also cause inflation to go higher as well. The Fed wants you to believe that by hiking up rates, they can bring inflation down. But how can they do this when they printed so much money, which ended up surging asset values higher? Their strategy damaged their very own end goal. It will be very difficult for central bankers to engineer a path from the dislocations that their policies have brought about in different parts of the economy. By printing so much money that targeted higher levels of inflation, the price of everything just skyrocketed, and the best example for the damage this has done is in the real estate. People often celebrate new valuations of their home prices, as if the impact of inflation only affected them. The entire housing market value went up, and unless you move to a drastically different area, you will not reap the benefits of selling your property. When everything comes crashing down, I can guarantee you Wall Street will be blaming people and non-corporate landlords for selling their own properties so high, dismissing any accountability for what they themselves have helped bring in. The central bankers forgot the fundamental forces of economics, and because of it, their policy making and psychology in addressing economic problems have only prolonged the issues or made them worse. Now with rate hikes, I don't expect things to get better. Rate hikes will not solve the fundamental issues of the economy. Those can only change by admitting everything the Fed has done is wrong and we need to undo it, which will never happen, and because it will never happen, the only way this comes to a grinding halt is a full market crash. And again, I don't think the crash is coming yet because I think the housing market has a lot more room to grow in inflation. In my opinion, the market crash can only be brought about along with the next housing crash, which is not that far off, but we aren't near that close either. Thank you for watching my video to its end. I hope to see you all in my Discord. Let me know what you thought about it in the comments. If you want to support this channel, Links are below for PayPal and Cash App for one-time donations, and my Patreon is there if you really want to spoil me. Enjoy the rest of your day and to the moon.